Hi guys, in this video we're going to discuss the different stages of investing in property. In previous videos we have talked about the roadmap and how to identify what your starting point is against what your goals are and what you're looking to achieve in property. And that's important because once you identify what your current financial situation looks like, you will then be able to work out what you are able to do and what you're not able to do. So there's no point in you picking a strategy without knowing what your finance ability is like, because it's all well and good to want to do, say, a development, for example, but if you can't raise the funds for it, if you don't have the income or the deposit or the security to be able to do it, then it's not going to work. So it's always best to understand what your current starting position is before making a decision on what strategy to pursue. Now, in some upcoming videos, we're going to be talking about how to source these opportunities and, more importantly, how to source the financing on these opportunities. But that's a video for another day, so keep an eye out for any upcoming videos that we'll be releasing. Now, who is this for? Now, if you are a person who is wanting to invest in property strategically and you don't want to make any mistakes, you want to be able to stack the probability of success in your favor, then this is a video for you. If you are a person that works really hard and you don't feel like you're moving ahead financially, you are worried about what the future may hold in terms of your ability to be able to self-fund your own retirement and be able to self-fund, your life's expenses along the way, and are looking for an opportunity or a way to make another source of income, whether it's a passive income or whether you want to go out there and move into the property and the real estate industry, then this is also for you. However, what I find is most people that want to embark on investing, many cases don't know where to start. They are usually subjected to the opinions of others and people around them. They don't know what they're able to do, they don't know what they're not able to do, and they're pretty much trying to wing it. And that is a recipe for disaster, because property investing is an expensive exercise. There's a lot of transaction costs on the way in and on the way out. So if you don't get it right, then it can be a costly exercise. So what we have done is basically given our clients a bit of a roadmap or a 3-stage process that they follow when it comes to investing. And as you can see on the graph here, we've actually split it into 3 stages. And we've categorized them based on complexity levels, because again, when you're first starting out, you don't want to be getting into something that's overly complex, and is going to jeopardize your ability on being able to pull off a good investment. So we always recommend that when you're getting started, look at doing low complexity, low risk, easier transactions, just to get your feet wet, just to get into the market and get familiar with the process of buying property. Start building up your team, start building up the people around you that's going to help you facilitate all future transactions. So what we mean by that is, if you start looking at things like house and land, apartments, townhouses, units, entry-level residential properties. Now, you'll find in most cases then they might not be the highest cash flow type properties, or they might not be the highest growth type properties. You're not going to be able to manufacture equity out of them. You might just do it as a buy and hold strategy to begin with. But if anything, you gain the experience, you gain the confidence, you understand the process, you gain the people and the network around you that can help you facilitate future deals. And look, in many cases, the properties do end up growing in value and they do give you a cash flow. But I mean, even if we work on worst case scenarios, you're still going to, give yourself a good foundation to start with. And in many cases, that foundation that you start with does give you the capital uplift as well along the way. So if you buy let's say a townhouse or a house and land package or an apartment, and you've spent $400,000 on that property, chances are in a 5-year period, it's going to be worth more than what you purchased it for. Or in a 10-year period, it's going to be worth, significantly more than what you purchased it for. And what that does is it gives you the equity to be able to use on your next purchase. And once you've built up a few properties in the stage 1 process, so we're talking, you've got 3 or 4 houses and each one of those houses has 100 grand equity in them, then chances are you're going to be able to use that equity to help fund other purchases in the stage 2 category. Stage 2 category are usually higher yielding properties. So we're talking commercial properties, duplexes, dual key properties, opportunities that are going to start giving you a cash flow. And it's going to give you a net cash flow, which you can start to rely on as income. Because although the stage 1 properties also give you cash flow, most of that cash flow is going to be absorbed in the interest and holding costs and the running costs of that property. Whereas your stage 2 properties are going to start giving you net cash flow that you can start to draw out a wage, a dividend, however you structure it. And you can then start to produce a bit of an income for yourself out of those properties there. So once you've got the equity out of your stage 1 properties, you've got the cash flow out of the stage 2 properties, this is when we recommend going into stage 3 type projects or properties, mainly around subdivisions, property developments, and projects. So this is where you are manufacturing equity and you're physically adding value to a property to improve its value. So this can be in the form of a subdivision where you're buying an old house on a big block and splitting it into 2 and selling off the land, or building on both of those land and selling both of them off or keeping them. It might be getting a house and then turning it into 5 townhouses and then selling a few off and maybe keeping a couple. It might be a renovation project, buying an old building and doing it up and either renting it out or selling that off. So the strategy can vary from person to person. However, as you go higher up the chain, yes, it's going to have a higher reward, but it's going to come with a higher element of risk and a higher degree of complexity. So if you are doing your first real estate transaction and you end up with say a property development and you get your numbers wrong, and all of a sudden you got your costings wrong, it's taking you longer to develop, you've made some mistakes along the way that you haven't been aware of, and you bought the wrong type of property to begin with, in many cases that can actually set you backwards rather than forward. So we would definitely not recommend going into the the stage 3 before going at least through a stage 1 property or a stage 2 property at the very least. One metaphor I can relate this to is building a house. When you build a house, you always start with the foundation first. You don't start building the frame before you've laid the concrete initially. You don't put the roof on until the frame's on. You don't start, wrapping and enclosing the walls and putting the brick around the house until you've got, at least the foundation, the framework, and the roof on. So same thing goes with investing. You want to start with the foundation first and then build on that slowly. If you do it the other way around, the property can come crumbling down. I mean, you might be able to pull it off, but it's going to be very, very high risk. So in terms of what actions I would encourage you guys to take as a next step is go back to the financial assessment and the roadmap exercise that we were doing. If you haven't got it, let me know and I can flick that through to you. Start getting a count of where you're at right now. So in terms of working at your ALIE, your ALIE, which is your assets minus your liabilities and your income minus your expenses, because your assets minus your liabilities will give us a good net position, which is a great scorecard to use. And your income minus expenses is going to give us the net cash flow, which is also going to be a good scorecard to use year on year. So I hope you got some good value out of this video. If there's any information that you need from me, please let me know. Otherwise, I'll see you next time. All right, cheers and have a great day.